In the year 2000, two men flew to Dallas, Texas, carrying a business proposal. They walked into a boardroom, sat down across from a room full of senior executives, and made an offer: buy our small, struggling startup for $50 million. The executives in that room didn't just decline. According to accounts of the meeting, they found the offer almost funny. One of the founders would later describe being laughed at. That struggling startup was Netflix. The company that turned it down was Blockbuster, a business so dominant that, at its peak, it operated over 9,000 stores and employed roughly 60,000 people worldwide. Blockbuster wasn't just a video store. It was a Friday night ritual for an entire generation. 10 years later, Blockbuster filed for bankruptcy. Netflix became one of the most valuable media companies on the planet. This isn't a story about luck. It's not a story about one company being smart and another being dumb. It's a story about incentives, about what happens when a business becomes so good at making money one way that it can no longer see any other way to survive. By the end of this video, you'll understand exactly how a company at the absolute top of its industry can miss the biggest opportunity of the decade, and what that means for you, whether you're running a company or just trying to make smart decisions in your own career. Let's get into it. To understand how big this collapse really was, you have to understand how big Blockbuster actually became. Blockbuster was founded in 1985 in Dallas, Texas, by David Cook. The idea was simple on paper, but revolutionary at the time. A video rental store with a massive selection, organized like a real retail store, with computerized inventory tracking so customers could actually find what they wanted. Before Blockbuster, video rental was a fragmented mom-and-pop business. Small shops with a few hundred tapes, inconsistent hours, and no real system. Blockbuster changed that. It brought retail discipline to an industry that didn't have any, and it scaled unbelievably fast. Wayne Huizinga, a businessman who had already built waste management into a national empire, bought a stake in Blockbuster in 1987 and turned rapid expansion into a science. Within a few years, Blockbuster wasn't opening stores one at a time. It was opening them by the hundreds, blanketing American suburbs with that unmistakable blue and yellow logo. By the mid-1990s, Blockbuster was a cultural institution. Going to the video store was a weekly event for millions of families. You'd walk the aisles, argue with your siblings about what to rent, grab a bag of candy at the checkout counter, and take your VHS tape, and later your DVD, home for the weekend. The business model was elegantly simple: charge a rental fee, and if the customer didn't return a movie on time, charge a late fee. And here's the detail that matters more than almost anything else in this story. Those late fees were enormous. By some industry estimates, late fees accounted for a significant share of Blockbuster's annual profit, reportedly hundreds of millions of dollars a year. Movie rentals got customers in the door, but late fees were quietly one of the most profitable parts of the entire business. Keep that fact in your head. It's going to come back later, and it's going to explain almost everything that happens next. By 2000, Blockbuster was doing roughly $6 billion a year in revenue. It had crushed nearly every regional competitor. It had leverage over movie studios, negotiating better distribution deals than almost anyone else in the industry. If you had asked any business analyst in America in the year 2000 which company was more likely to dominate the next decade of home entertainment, nobody would have hesitated. Blockbuster looked unstoppable. Think about what that kind of dominance does to a company's internal culture. When you're winning that decisively for that long, the entire organization starts to build itself around defending the win. Real estate teams get rewarded for signing more store leases. Regional managers get rewarded for squeezing more revenue out of existing locations. Finance teams build 5-year forecasts, assuming the current model just keeps compounding. Nobody inside that machine is incentivized to ask, what if this whole model disappears? Because asking that question doesn't help you hit this quarter's numbers, and hitting this quarter's numbers is how you get promoted. That's not a criticism of any individual person at Blockbuster. It's just what happens, almost mechanically, inside any organization built around a wildly successful, well-understood business model. The bigger and more profitable the machine, the harder it becomes to imagine turning it off, even in favor of something better, which is exactly why what happened next is so important to understand. while Blockbuster was busy being the undisputed king of video rental. Two entrepreneurs on the other side of the country were building something that, on the surface, looked almost too small to matter. Reed Hastings and Mark Randolph founded Netflix in 1997. The origin story has become part of Silicon Valley legend. Hastings has said the idea partly came from being charged a $40 late fee on a rented copy of Apollo 13. Whether or not that's the full picture, the frustration was real, and it pointed at something bigger. The entire rental model was built around punishing customers for being late. Netflix's original idea flipped that completely. Instead of walking into a store, customers would order DVDs online and receive them by mail in a red envelope. No due date, no late fees. Keep the movie as long as you wanted, then mail it back and get the next one on your list. In 1997, this idea was, frankly, a little absurd to most people. DVDs were a brand new format. Most Americans didn't even own a DVD player yet. Mailing discs back and forth seemed slow and clunky compared to just driving to the store. For its first few years, Netflix was small, unprofitable, and largely dismissed as a niche service for tech-savvy early adopters. But Netflix had something Blockbuster didn't: a business model with completely different incentives. Blockbuster made money when customers came to the store, and made extra money when customers messed up, when they forgot to return a movie on time. Netflix, on a flat monthly subscription, made more money the more convenient and frictionless the experience was. Every late fee eliminated wasn't a loss for Netflix. It was the entire point of the product. By 1999, Netflix had introduced a subscription model that would define the company. Pay a flat monthly fee, get a set number of DVDs at a time, keep them as long as you want, return them, and the next ones in your queue would ship automatically. It was still small. It was still losing money. But it was solving the exact problem that made people quietly resent their local Blockbuster. There's something worth noticing here about how Netflix actually built its business in those early years, because it wasn't glamorous. They weren't running national ad campaigns or opening flashy offices. They were obsessing over unglamorous operational details. How fast a DVD could get from a distribution center to a customer's mailbox, how to reduce scratch disk complaints, how to build a recommendation algorithm that kept subscribers engaged so they wouldn't cancel. None of that made headlines. But it meant that by the time Netflix walked into Blockbuster's boardroom, they weren't just pitching an idea. They'd already built the operational muscle to execute at scale, even if the subscriber numbers were still small. That distinction matters, because it's easy to look back now and think Netflix was an obviously brilliant idea from day one. It wasn't obvious at all. Plenty of smart people in 1999 thought DVD by mail was a gimmick that would never beat the convenience of just driving to a store you already knew, in a neighborhood you already lived in, to rent a movie you could watch that same night. Netflix's bet wasn't that mail-order DVDs were the permanent future. It was that removing friction and punishment from the customer relationship was a permanent future, and mail-order DVDs were just the best available way to prove that idea in 1999. This brings us to the year 2000, the moment this whole story hinges on. Netflix, still years away from profitability, was burning through cash. The dot-com crash was hammering internet startups across the country, and Netflix wasn't immune. Hastings and Randolph knew they needed either more capital or a partner with serious infrastructure and resources. So they picked up the phone and set up a meeting with Blockbuster. The pitch, according to multiple accounts from people involved, was straightforward. Netflix would become Blockbuster's online rental brand. Blockbuster would promote Netflix.com in its thousands of physical stores, giving Netflix instant access to a customer base Blockbuster had spent over a decade building. In exchange, Blockbuster would essentially acquire Netflix for $50 million. Think about what that combination could have looked like. Blockbuster had the brand recognition, the physical footprint, the negotiating power with studios, and the balance sheet. Netflix had the technology, the subscription model, and, most importantly, a fundamentally different way of thinking about the customer relationship. If those two things had merged in the year 2000, it's entirely possible that Blockbuster, not Netflix, would have been a company that eventually built the world's dominant streaming platform. Instead, According to accounts of the meeting that have circulated in business media for years, Blockbuster's executives were unimpressed. Netflix was a tiny company losing money, with a customer base a fraction the size of a single Blockbuster region. From where Blockbuster's leadership sat, this wasn't a merger of equals. It was a favor being requested by a struggling startup. They passed on the deal. Netflix walked out of that meeting with no partnership and no acquisition. But they also walked out with something more valuable in hindsight: total ownership of their own future. It would be easy to end this story here and just call a bad decision. But the more interesting and more useful question is why a room full of experienced, successful executives looked at Netflix and saw nothing worth $50 million. The answer isn't stupidity. It's something almost every large, successful company eventually runs into. The business model that made you dominant becomes the exact thing that blinds you to what's coming next. Remember those late fees? By the early 2000s, they were estimated to represent a meaningful chunk of Blockbuster's total profit. Some estimates put the number in the hundreds of millions of dollars annually. Blockbuster wasn't just a rental company. In a very real sense, it had quietly become a late fee company that happened to rent movies. Now imagine you're a Blockbuster executive in that boardroom. Netflix's entire pitch is built around eliminating the exact revenue stream that's propping up a meaningful part of your profit margin. From a pure number standpoint in that moment, buying Netflix didn't look like acquiring the future. It looked like paying $50 million to tack your own bottom line. This is what business theorists often call the innovator's dilemma. Successful companies get very good at optimizing the thing that currently makes them money, and that same optimization makes it organizationally difficult to invest in something that would undermine it, even when the writing is on the wall. Blockbuster's leadership wasn't blind to the internet. They weren't blind to changing technology. They were trapped by an incentive structure where every quarter, the safest and most rewarded decision was to protect the existing model, not disrupt it. There's a second factor, too: sheer scale bred overconfidence. Blockbuster had spent 15 years crushing every competitor that came along: local video stores, regional chains, even early attempt at rental kiosks. Why would this tiny mail-order DVD company be any different? Confidence built from years of winning made it easy to underestimate a threat that didn't look like previous threats. And that's really the core lesson sitting inside the specific moment. Netflix wasn't just building a slightly better version of Blockbuster's business. They were building an entirely different business, with entirely different incentives, wearing the disguise of a small and profitable competitor. Blockbuster evaluated Netflix using Blockbuster's own rulebook: store footprint, current revenue, current market share. And by those rules, Netflix looked irrelevant. There's also a simpler, more human explanation sitting alongside all of this. It's genuinely hard to take a $50 million proposal seriously when it's coming from a company smaller than one of your regional divisions. Status and scale shape judgment more than most executives would like to admit. When a giant looks at a minnow, the giant's instinct is almost never, "This minnow understands something we don't." It's, "We could build whatever they're doing ourselves." If it ever actually mattered, that instinct is usually correct. Just not this time, because building it themselves would have meant deliberately undercutting the profit engine that funded their bonuses, their stock price, and their entire theory of the business. Here's what makes this story more interesting than a simple "they said no and lost" narrative. Blockbuster didn't just sit still for the next decade. They actually tried to fight back multiple times. And watching how they fought back tells you almost as much as the original rejection did. By 2004, Netflix had grown to roughly 2 million subscribers and was becoming difficult to ignore. Blockbuster finally launched its own online DVD by mail service, Blockbuster Online, directly copying Netflix's model. They had the studio relationships, the brand awareness, and far more cash than Netflix had ever had access to. For a moment, real competition looked possible. Then, in an even bolder move, Blockbuster eliminated late fees altogether in 2005, branding the campaign "No More Late Fees." On the surface, this looked like exactly the customer-first pivot the company needed. But the financial reality was brutal. Eliminating late fees was estimated to cost Blockbuster somewhere between $200 and $400 million a year in lost revenue. The exact revenue stream that had quietly been propping up their profitability for years. This is where corporate politics entered the picture. The push toward online rental and eliminating late fees was largely driven by CEO John Antioco, who seemed to genuinely understand the threat Netflix posed and was trying to reposition the company. But the strategy was expensive, the transition was messy, and it put Antioco in direct conflict with Blockbuster's board, particularly activist investor Carl Icahn, who had taken a major stake in the company and pushed back hard against the spending required to compete online. The result was a prolonged, damaging leadership battle. Antioco eventually left the company in 2007, and much of the momentum behind Blockbuster's digital pivot left with him. Subsequent leadership scaled back some of the online investment, tried to stabilize short-term profitability instead. In hindsight, this was close to the worst possible moment to lose focus, because Netflix was about to change the game again. In 2007, Netflix launched streaming, not as a replacement for DVD buy mail at first, but as an added feature. Customers could now watch a limited library of content instantly, no envelope required. It was clunky in the early days, with a small selection and streaming quality that depended entirely on your internet connection, but it pointed directly at the future. What's striking is that Netflix made this move while its own DVD buy mail business was still healthy and growing. They weren't reacting to a crisis. They were cannibalizing their own most successful product on purpose, years before they had to. That's an almost unnatural decision for a company to make. And it's exactly the kind of decision Blockbuster's internal structure made nearly impossible. Netflix could do it because streaming and DVD rental were both just expressions of the same underlying mission. Remove friction from watching what you want, when you want it. Blockbuster couldn't do it as easily, because a full pivot to streaming meant openly admitting that thousands of physical stores and the tens of thousands of employees running them were becoming a liability rather than an asset. That's not a strategy memo. That's an organization having to say out loud that its own core identity is becoming obsolete. While Netflix was pouring resources into streaming technology and licensing deals, Blockbuster was still primarily a company built around physical stores, leases, in-store staff, inventory logistics, shelf space. Pivoting a company with thousands of physical locations toward a digital-first future isn't just a strategic decision. It's an enormously expensive, organizationally painful one. Blockbuster tried, but the internal fighting, leadership turnover, and mounting debt made a full pivot nearly impossible. By 2010, the math had become unforgiving. Blockbuster was carrying roughly $1 billion in debt. Revenue was collapsing as customers shifted to streaming and to Redbox's cheap DVD kiosks, and store traffic kept declining. On September 23, 2010, Blockbuster filed for Chapter 11 bankruptcy. Netflix, meanwhile, had grown into a company with tens of millions of subscribers and a market valuation that would eventually dwarf anything Blockbuster had achieved at its peak. The company that had once been turned away with an offer of $50 million became worth well over $100 billion in the years that followed. Today, there's exactly one Blockbuster store left in the entire world, in Bend, Oregon, kept alive largely as a nostalgia destination and tourist attraction. It's tempting to walk away from this story thinking the lesson is simply adapt to new technology or die. But that's too easy, and honestly, it's not quite accurate. Blockbuster did try to adapt. They launched an online rental service. They eliminated late fees. They even experimented with streaming years before most traditional retailers took digital seriously. The problem wasn't that Blockbuster ignored the future entirely. It's that they kept trying to protect the past while doing it. The deeper lesson is about what a business optimizes for, often without even realizing it. Blockbuster's entire operating model, its store footprint, its staffing, its profit margins, even its late fee revenue, was built to reward one thing: keeping the existing system running as efficiently as possible. Every incentive in that boardroom in 2000 pointed toward protecting that system, not replacing it. Nobody in that room was evil or incompetent. They were simply optimizing for what had always worked, right up until the moment it stopped working. Netflix won not because they had more money, more brand power, or more industry experience. They had none of those things in 2000. They won because their entire business was built around removing the exact friction that customers hated, even when doing so seemed to work against short-term convenience. They were willing to make a worse business today in exchange for a better one tomorrow. Blockbuster, understandably, was not. because tomorrow wasn't guaranteed, but this quarter's late fee revenue was. This pattern shows up over and over across business history, in industry after industry. The company defending the profitable status quo rarely beats the company willing to make that status quo obsolete. Kodak invented the digital camera and shelved it to protect film sales. Taxi companies dismissed ride-sharing apps as a fad. Traditional retailers dismissed e-commerce as a niche. In every case, the incumbent wasn't blind to the new technology. They were trapped by the profitability of the old one. What makes the Blockbuster story stand out from those other examples is how avoidable it looks in hindsight and how close the alternate timeline actually was. This wasn't a case where the disruptive technology hadn't been invented yet, or where the threat was genuinely impossible to see. Netflix walked directly into Blockbuster's headquarters and explained, in plain language, exactly what they were building and why. Blockbuster had the opportunity to buy the future outright for a price that, relative to their $6 billion annual revenue, was almost a rounding error. $50 million was less than what Blockbuster would go on to lose in a single year from cutting late fees alone. The company didn't fail because the warning never came. It failed because the warning arrived in a form its own success had trained it not to recognize. So here's the real question worth sitting with. Whether you're running a business, building a career, or just making decisions inside a company you don't own, what are you protecting right now? A habit, a process, a revenue stream, a way of doing things, simply because it's comfortable and currently profitable, even if you can feel somewhere in the back of your mind that it's not going to last? Blockbuster had every advantage in the world. What they didn't have was a reason, inside their own incentive structure, to bet against themselves. Netflix did, and that one difference is worth more than the $50 million that started this whole story. If there's one thing to take from this case study, it's this. The biggest threats to any business rarely look like threats at first. They look small and profitable and easy to dismiss, right up until they aren't. If you found this breakdown useful, hit subscribe. Every week on this channel, I take a real business decision, a merger, a rejection, a bet that paid off or blew up, and break down exactly what happened and why, so you can start recognizing these patterns before they cost you money, time, or an entire company. And I want to hear from you. If you were sitting in that Blockbuster boardroom in 2000, would you have said yes or no? Drop your answer in the comments and tell me which companies rise or fall you wanted to cover next. I read every single comment, and a lot of upcoming videos on this channel come directly from your suggestions. Thanks for watching. I'll see you in the next case study.